Yeah, look, thank you very much for joining us. As Alex said, we are a South Australian gold developer, so this is something that we've really focused on for the past couple of years. The theory in South Australia is that it has really profound global geology. So this South Australia as a state is very known for its copper mining, its uranium mining. It's home to the Central Gawler Craton, which is where BHP have the Olympic Dam, Carrapateena, and Prominent Hill assets. But that same mineral basin, as it trends to the west, goes from being sort of deep and coppery to shallow and goldy. And about 5 years ago, we executed a strategy to consolidate the ownership of every significant historical exploration and producing gold asset in that region. It's been producing gold for 130 years. We also took control of the only mill. And the strategy was to step back, build up a much larger platform. We're not targeting production of 50,000 ounces, we're targeting production of 150,000 ounces per annum. And we've now, over the past 3 to 4 years, advanced these assets to the point where they're ready to start coming online sequentially. So stage one, we'll restart our existing Central Gawler mill, processing material from what we call our stage one area. And then stage two, we'll use the cash flow from that to expand into our Tunkillia asset, which will take us up to about 150,000 ounces per annum. So the idea is to get to a very large, valuable producer with a much more staged, lower cost, lower risk, and therefore lower dilution proposition. So for us, these first few months of the year have already been pretty exciting. The next few months, we are going to be publishing an optimized scoping study for our large-scale asset. We are going to be doing a number of resource upgrades. We are going to be then publishing the plan to start our stage one operations during 2026. Sort of very interesting inflection point for the company as we essentially go and commercialize the strategy we've built for the past 5 years. Our capital structure is very simple, very clean. We have about 219 million shares on issue. A very, very tight capital structure, 80% ownership between board, management, institutional, and family office. And that really is a function of a consistent consolidation of our shares around strong board and management alignment, but very consistent capital efficient performance. And one of the things I mean when I say capital efficient performance is, one, we are very good at how we spend money. We're all professional asset managers who happen to actually just be operating physical assets here. But two, we also work these assets. So we're not just looking to start our stage one operation to fund our stage two. We use our existing assets as they are today to fund our pre-development activities. We've actually generated about $12 million in net additional free cash flow, just internal to the company over the past 4 years. And what this means is we've had very, very little dilution. Many of our peers have been raising money every 6 to 12 months to stay alive. We've only raised $6 million US publicly in the last 4 years. So we're largely self-funding. This means that our shareholders that we had 4 years ago are our shareholders today, and this strategy is why today's shareholders are going to own the benefit of our success tomorrow. And a lot of this activity, a lot of this sort of track record of progress and sort of exceptional outcomes really reflects our team. So we have a leadership team between the board and the senior management that have well over 300 years of experience exploring for financing, building, and operating major mining assets. We have a particularly strong pedigree both in gold and in South Australia. About half of my leadership team came from Normandy Mining, which some of you may remember from the 1990s. Normandy was the largest gold producer in the Southern Hemisphere until they were acquired by Newmont Mining in 2002. They were a 2.5 million ounce per annum producer. So we have the skill set from the in-the-ground geology up to making multi-billion-dollar hedge book markets. Our position is to move these assets forward through sequential development. And what that means when you look at this on a map is you can see we've drawn some lines here around what we call our stage one and stage two areas. We started in this very quiet gold market of the past 3 to 4 years, focusing on that distance, the sort of distance asset, the asset of consequence, the one that would take us to scale. And that's our Tunkillia asset that you see there in the southeast. Our existing mill is there in the northwest. We built up that Tunkillia asset. We've demonstrated that it will be a large-scale gold producer very efficiently. And now we're actually shifting our attention back up to this sort of stage one project area. This is an area that we've not really been talking about publicly too much, but we have an existing mill. We can refurbish that. And we have multiple bodies of mineralization that we haven't updated resources on for the past 4 years. So for the next few months, we're going to go through and systematically update those resources as well, and then come up with a plan and demonstrate the plan for how that's going to operate. So this is really a visual explanation of how we start in the northwest, refurbish an existing mill for a relatively small amount of money, go to 20,000 ounces, then add in production from Tarcoola, go to 40,000 ounces, and then expand into Tunkillia and go to 150,000 ounces. So instead of trying to jump from 0 to 150,000 ounces in one big jump, which is very costly, we're actually going to use our existing mill to start cash flowing operations, become self-funding, re-rate our equity, re-rate our credit, and then build our second mill as an expansion of an existing producer. Now we're focused on that asset in the southeast and focused on scale for a reason. It's because scale works. Scale is actually the number one determinant of profitability in mining. You hear a lot of people talk about grade being king. That is a very incomplete statement. Volumetrically adjusted and risk-adjusted grade might be king. But in many cases, getting to high grade means spending $1 billion and getting through 800 meters of rock before you get to that mineralization. We're fans of open pit mining for this reason. So we focus on big bulk open pit mining. And we model what we do based after a company called Capricorn Metals, which some of you may know. They have a project called Karlawinda, which looks a lot like our project. And basically, they grew that asset from something that looked like ours when we bought it up to a 120,000 ounce per annum producer. Now, they process about 4.5 million ton per annum. They have a 0.7 gram resource, but today they're one of the lowest cost gold producers in Australia and in the world. So we've emulated that project. We acquired one that looked a lot like it. We've grown it to now 1.6 million ounces. And what it looks like is a huge body of mineralization along the western margin of a shear zone. It gives us some very, very interesting numbers in terms of production metrics. So we're looking at producing around 130,000 ounces per annum of gold at an all-in sustaining cost of about 1,900 Australian or about 1,200 US dollars. So that's globally bottom quartile on the cost curve. But that number is actually based on some very conservative assumptions. We are going to be putting out in the next month or two an updated scoping study, which is going to demonstrate that this is a very, very attractive million-ounce style asset, producing in the bottom quartile globally. And this is something that we'll look to grow over time. It's the geometry of the geology here that really dictates the economics. So this is very big, broad, bulk open pitable mineralization. And we have this higher grade zone right in the middle. Is very, very interesting. And what it gives us, and this is one reason why our financial partners are so interested in this asset, is you can see in these two columns of data here on this table, the kind of horsepower you get out of economies of scale on that sort of life of mine average. So this is a 5 million ton per annum plant, producing 130,000 ounces per annum at a cash cost in US dollar terms of around $1,200. But if you look to column to the right, what you can see is in this starter pit that we have, which is just that little yellow outline there, that first 5 million tons produces 180,000 ounces. And what that means is your cash cost is not 1,900 Australian dollars or 1,200 US, it's about 1,200 Australian dollars or about 700 US. So the first 5 million tons that we get here will generate over $400 million in gross free cash flow. So we'll functionally have less than a 1-year payback. When we look just to the north, we have our Tarcoola asset. This is actually where South Australia had its high-grade gold rush in 1893. We own all that ground. There's an existing mine on that ground that we've put some mineralization in the pit floor. So this is material that will go to our mill for our stage 1 operations. We're looking to have this operating in 2026. But what's more interesting here is this is actually a re-emerging gold field under our ownership. This gold field has produced high-grade gold from small-scale artisanal mining for 130 years. We're the first people to step back and actually map what the subsurface architecture looks like. And we've now made a number of gold discoveries in there, one of which is this Tolmer project. And Tolmer's quite interesting, one, because it's a high-grade gold discovery, but we've just announced 2 days ago a very, very high-grade silver discovery here. This is something that's entirely new in this gold field and something you could only find if you're really doing diligent work on your structural analysis. We drilled one hole that we reported, I think, on Wednesday, 6 meters at 4,700 gram per ton silver. That is one of the highest grade silver intersections in Australia wide. Australia is not known for high grade silver, so this is very, very interesting and something that we'll be coming back to. In summary, what are we doing? Well, we are in this very interesting period. The next few months, up to the 30th of June 2025, is really going to be about a couple of things. One, crystallizing the large-scale economics of our Stage 2 asset. Two, bringing together the plan for our Stage 1 operations starting in 2026, and then putting those together and saying, here is your plan now for a runway to 150,000 ounces per annum, starting with a very small amount of money that will be starting in 2026. So it's a very interesting time for the company, and really in terms of what we have, how we're valued. You know, we have a 50 $50 million, sorry, 60 million Australian dollar valuation, 40 million US dollars roughly, for $250 million with infrastructure and around 2 million ounces of gold. And we're going to be starting production next year. So very, very, we think, performance-driven value proposition. Thank you very much.